Hi everyone, hope you had a great festive season. Diversification is sometimes referred as the only free lunch in investing. But is it really true? In this video, I talk about how concentrated or diversified your portfolio can be and what are those important factors to consider before you decide your portfolio approach. Let us start with understanding how concentrated is too concentrated. Many of you may think or can ask this question saying, if by adding investments, I'm reducing the portfolio returns, is it simply not better to invest all the money in those assets or the stocks or the funds that gives the highest possible return? A great question, but the answer is very simple. You and I can go wrong. However well we analyze and execute, there is definitely no certainty when it comes to investing. At best, you can get the odds heavily skewed in your favor, thereby increasing your chance of winning. Therefore, it is important for you to build in a margin of safety at portfolio level and also underwrite each investment, and that's a critical thing to do. The question really is what is that loss below which you will start losing that margin of safety? For an instance, I would prefer not losing more than 10% of the capital or have a permanent damage of 10% at any given point in time because I believe the other 90% will grow reasonably well to compensate for the damage, and therefore my margin of safety is 10%. Going by that analogy, I would build a portfolio of stocks or funds that will have a minimum of 10 stocks and thereby reduce the PAR, which is nothing but portfolio at risk. Let's now move to diversification. Increased diversification comes with two potential costs. At some point, new investments are expected to lower the portfolio returns, and the more the diverse the portfolio is, the more underwriting you need to do, thereby reducing the focus on the existing investments. Let's take two different market scenarios. One in which the new potential investments come at very similar IRR, internal rate of return. In the scenario two, the additional potential returns comes at a much lower IRR than the earlier one. So in scenario one, it's a no-brainer. The diversification comes at a much lower cost and hence it makes sense to diversify your portfolio. In scenario two, each investment is lowering your portfolio return and therefore the more the diverse the portfolio is, the lower the return and the cost therefore is high. Here it warrants concentrated portfolio. Now, what about the time cost of diversification? Each investment that you add will take away the focus that you would have on the earlier investment. This might seem like a problem that can be solved by adding resources, but like in many investment process, certain decisions cannot be delegated and are best handled by the investment head himself. Therefore, by diversifying too much and also delegating too much, you are expected to reduce the quality of the work or at least reduce the confidence in the conclusion. So you may have to add this cost before taking a final call of whether to diversify or to have a concentrated portfolio. In an environment where companies and industries are deeply undervalued, the time needed to add new investment to the portfolio is very limited. On the other hand, if the opportunities are scarce and are spread across various pockets of the market, the learning curve of new investment is very steep. Therefore, in a scenario where there is widespread undervaluation and good companies adding very similar returns, it makes sense to go in for a diversified portfolio. In all other cases where the environment in which the opportunity cost and time value cost of diversification is very high, the logical course is to take a concentrated portfolio approach. So in any given circumstances, your portfolio might have about 10 to 20 different investments. The level of concentration will of course depend on what is the environment and the kind of opportunities available at that particular point in time. Now, returning back to the free lunch bit, the old adage still holds true when it comes to investing and in life. There is no such thing, even when it comes to diversification. But the bigger question to answer is how concentrated or diversified is your portfolio? And you should definitely check with us.